Hi guys, Doc Severson here for the Theo Night Report for Tuesday, February 14th. I've got a tick chart of the S&P 500 here, just the SPX. And the reason why I want to show this view to you is because of what I call the GroundHog Day Effect that we've seen over and over again for the last 8 years or so. Now, the way that a day like this sets up is usually some type of gap down or at least initial weakness out of the gate. In this case, we can see that about the first 90 minutes after the cash market opened, it actually started trending to the downside. And to some degree, that actually followed up from the last hour or two of Monday's cash session as well, right? So we have this market trending down. Everybody thinks, oh, here it is. Here's the top. Finally, after all of these years, here is the actual top of the market. Time to start shorting. And the bulls know exactly where to pick on these guys to be able to get these weak hand shorts out of the market, squeeze them to the upside, and then the cycle starts all over again. So to me, that's kind of the Groundhog Day move that we've seen many, many, many times over the last 8 years. Now, what about the opposite effect? When would we see something like that, or how would we identify something like that? Well, usually when we have corrective action, we see quite the opposite occurring. We have a market usually heading down on this type of basis, and what we will typically see from that is a gap up in the morning. All of a sudden, everybody's optimistic. Here we go. We're going to fix the downtrend, and it starts to gap up, and then the exact opposite thing happens is that then, too, that market gets shoved underwater. But in between that, we really have a third type of market, which is where a lot of these top reversals come. We don't see them that often, quite honestly, but what they look like is typically a market that starts off like gangbusters early on in the morning, and then at some point in the day, the early rally gets faded really strongly. Now, we've seen this happen a few times recently. There's not been much follow-up on that, but this is typically the action that we see is an initial push up, and then that's immediately faded and starts to work into lower lows and lower highs. So that's kind of the attitude of buying them to sell them later on. It's almost as though it's a manufactured move where things get pushed up to create that type of frenzied activity that generates retail buying activity and generates enough volume that institutions can sell into that without moving their own markets against them. So I would say in the near term, any weakness out of the gate is to be suspect, and watch whether that descending pattern gets broken to the upside. Number one. Number two, anything that's really, really strong out of the gate is also to be suspect. See whether or not that will also break. Usually you can determine these within the first hour or so of the market. So there's no harm usually in sitting out that first hour and let the market show its hand first before you jump on the eventual trend. So today, looking at the S&P 100 here, the top 100 companies of the S&P 500, we can see an awful lot of green. The big star here was actually GM, up over 4.5%. So we'll take a look at that one in just a minute. But most of the others were, you can see that we were up 72, down 27. So about a 3-to-1 advantage for the bulls today. And that, of course, came after that early reversal. Now, just for a macro view on the S&P 500, the actual sector spiders here, the financials was the big star here today. The financials were sort of weak early, did not look like they were going to participate, and all of a sudden, boom. And perhaps some of that came from the Yellen testimony. I've yet to figure out if there was anything actually said in there that made news, but perhaps financials rallied on the certainty that came out of that testimony in front of Congress. Another day tomorrow, usually the second day, does not move markets like the first. So here's that XLF chart. This is the Sector Spider Financial ETF, and this one is still relatively cheap at about $24 a share, still attracting a lot of retail participation. Frankly, it's one of the few stocks that people can still afford in today's market. And it's doing exactly what it's supposed to be doing. from range contraction like this, building up a tremendous amount of power to be able to break loose from here. Think of this as just the spring winding and coiling up here more and more, breaking above this level. And now what we're seeing is some of these candles dropping off the back. There's only a certain amount of linearity that any kind of trend can go to, and we push this one to the very limits right now, but you can see that as these candles drop off the back, it's actually recovering nicely on the weekly chart. Now, the problem here is the monthly chart. Typically, as we get down to a level of about around here, this is where we'll start to see a larger time frame consolidation kick in. This was the one that pretty much everything went sideways in 2004 after the 2003 recovery rally. We had another rally here in 2010, right? So a big rally in 2010 off of the bottom here. Imagine that, $4.77. Oh. So we're seeing the same kind of thing here, is that once this gets down to this area, now 2013 kind of consolidated on the fly. It just slowed down and just sort of chopped along the way, and that's the third way that a market can consolidate. So the big question now is what's going to happen with the financials as they get down to this point in the next month or two. I'm thinking that probably we're just going to see a little bit larger base like this set up and not necessarily see this thing just completely drop off. The other way that we can see this, though, like what we saw in 2013, is just a continual, persistent upside grind. Now here's that GM stock that we talked about that showed up on the S&P 100 Market Watch, and you can see that they've released earnings here with $1.28. So this was clearly well above the estimated $1.14. So we're seeing GM catch a bid here and was up almost 5% today alone. So this actually is also another pattern that has a lot of power behind it. So there's a lot of potential here for General Motors to be able to catch a bid here, and it's still relatively inexpensive. And if it can show that it can generate earnings on a regular basis, we've started to see a lot of breakouts from chart patterns here. This has a lot of power to it, so this could easily start to regain some of these numbers up here. And one that came to my attention this afternoon was Ford, which is another long-term pattern here that's built up a tremendous amount of energy and could actually be a good long candidate coming up out of here. In fact, this may be a good long candidate just for stock alone. Now, this is not much of an option play. Really, the expected move on this thing is just next to nothing. Really, it's next to nothing, right? So one way to play this, though, and this is much more aggressive, but when we do see stocks like this in this huge of a consolidation, nobody's giving this thing the benefit of the doubt for any kind of a move whatsoever. And so what you can find is one of those types of moves from a pattern like this where the market is completely discounting any form of large move from here. So what that means is that the out-of-the-money options in this case are very, very inexpensive. That is not something that we typically do, buying long out-of-the-money options. You know, this is usually the first mistake that a newer trader learns to stop doing. But in a case like this, this might almost be a really good probability play of setting up some long out-of-the-money options on something like Ford. This is a massive pattern, and when this does break this pattern, there is going to be a huge amount of movement from Ford. All right, folks, that is it for today's report. Watch that groundhog move, and we'll see you with tomorrow's report. Take care.